The Wall Street Journal is out with an article today titled U.S. Stocks Need a Santa Claus Rally to Avoid a Losing Year. Yes, typically we do get a Santa Claus rally last week of the year and the first couple of days of the new year. Joining us right now to talk more about markets and investing today is Federated Investors Chief Equity Market Strategist Phil Orlando. Phil, good to see you.
Thanks for having me back.
It's been a tough year for markets.
It's been a tough 3 months for markets. We had a nice period up until that August-September period. The S&P's pulled back about 12% in the last couple months. NASDAQ and the small caps are down about 16%. Yet you've got an environment where corporate earnings are up 25% this year. So multiples have contracted 3 points from 18 to 15 over the space of the last couple of months. Sentiment is terrible, but it seems as if the market is trying to price in a recession for next year, and we don't see it, which means that this will reverse. But the question is, when is that reversal going to come? And that becomes the sentiment versus fundamental tug of war.
What do you think? Is it all interest rates that's bothering markets so much, or is it the trade story, this uncertainty over China, or all of the above?
Yes.
Yeah, all of the above.
It's an impressive wall of worry right now.
Yeah.
You know, you look back over the last couple of weeks, and there were a couple of signposts that we were looking for, starting with Jay Powell's lunch that you and I were at in New York a couple of weeks ago.
Yes. We
got exactly what we were looking for out of that lunch. The Fed gave us tacit acknowledgement that the U.S. economy was a little slower, global economy was a little slower, and the Fed would not be as aggressive in raising rates.
A real pivot.
Which was excellent. And then we will follow that up with the meeting today, this week. So hopefully that's good. The second thing then was the G20 meeting that weekend. We were hoping that Trump and Xi would have a sidebar dinner in which they didn't throw knives at each other and agreed to push the tariffs out a quarter or two and allow their people to work on the details over time. And that occurred. And then we got the OPEC meeting the following weekend, where we're hoping for a 1 million barrel production cut out of the Russians and the Saudis. We ended up getting 1.2 million barrels. That puts a $50 floor under crude. So all of the things that we needed to see to sort of prop up sentiment has happened, and the market's not responding.
In terms of sentiment, I've been watching the Dow transports because the week prior they were down 8%. That was the biggest weekly drop in more than 7 years. Last week, another roughly 4% loss on the transports. The month to date, the Dow transports have shed 12% just in the month, putting it on track for its worst month since February of 2009. That might be good, but that was still in the middle of the bear market coming off the financial collapse, but it was toward the end of it. But again, if you want an economic gauge, watch those transports, and it has been horrible for those stocks.
There's no question. But on the other side of the coin, the labor market's been pretty solid. We just got another, I think, relatively upbeat read on the consumer on Friday with retail sales. Christmas is going to be pretty decent. So there's no question that the housing market, the auto market, some of the manufacturing metrics have slowed here. But the consumer still accounts for 70% of GDP, and that portion of the economy has been relatively solid. We don't see a recession in the United States in 2019.